A laptop screen displays line items of a financial statement. Figure 4. One accrual accounting reports revenue when goods are delivered or services are performed but are not necessarily paid for. Credit. Modification of work, reviewing financial statements by instructional institutions. Chapter outline. 4.1 Cash versus accrual accounting. 4.2 Economic basis for accrual accounting. 4.3 How does a company recognize a sale and an expense? 4.4 When should a company capitalize or expense an item? 4.5 What is profit versus loss for the company? Emma, an accounting major, was on her way to her Wednesday morning accounting class with her friend Sam. Sam, a finance major, kept complaining to Emma that he didn't enjoy their accounting class at all. Why do we have to spend so much time worried about debits, credits, accounts, and all this other accounting jargon anyway? I'm a finance major. I won't be spending my days recording entries and counting pennies. I'm dreading class today. I looked at the syllabus. We're studying the accrual method. So what? Just give me the financial statements so I have the data I need. Emma smiled at her friend and thought for a moment before responding. Emma loves the details of debits, credits, and all that other accounting jargon, as Sam put it. She knows that while not everyone enjoys the details or understands them, they do play a big role in the timing and accuracy of financial statements. Yeah, Sam, accounting isn't always easy or fun, but it's important. The financial statements you will use in finance are a part of the foundation for many decisions. They are an important tool. Even though you don't have to create financial statements in a finance role, it's still necessary to understand the accounting principles they are based on. We haven't covered the details yet, but I do know that income or loss in a period can be significantly different if the income statement is prepared under cash versus accrual methods. I would think that would be important to know if you are the one using the income statement. Learning outcomes. By the end of this section, you will be able to outline the key concepts of the cash basis accounting method, explain the key characteristics of the accrual basis accounting method, identify businesses for which cash accounting or accrual accounting is more appropriate. In this section, we will explore the basic elements of cash and accrual accounting and the businesses that are most likely to use each one. Some private companies may choose to use cash basis accounting rather than accrual basis accounting to report financial information. Cash basis accounting. In business, cash is certainly important. In fact, it's so important that it dictates one of two ways we can account for our business transactions. The cash method is just as the name implies. It records transactions only when cash flows. We track cash inflows and outflows as they occur. This method is most commonly used by small businesses that deal primarily in cash transactions. The other method, called the accrual method, records transactions when they occur, rather than waiting for cash to be accumulated. Using the accrual method, we match cash inflows and the outflows required to generate them. We call this the matching principle. This method is used by most publicly traded companies. In this chapter, you'll explore both methods, see how each impacts financial statements differently, note the role of timing in each method, and learn how and when to record capital and expense transactions. Let's look at an example. Chris just finished the first month of her landscaping business operations at the end of August, and she used the cash method of accounting to figure out her net income. Most small startup companies use the cash method of accounting because it is easy to understand, requires no special training, and helps them focus on one big key to their survival: cash. This means that she simply recorded the cash that came in and the cash that went out of her business. She brought in $1,400 in revenue in her first month, which she felt was substantial given that it was her first month. But after deducting her expenses, she had only $250 left, so she worried about the future of her business. Would she have to increase her sales exponentially in order to start bringing in a decent profit each month? As you move through the chapter, you'll get to see the impact of the two methods of accounting and how these methods impact the insights and decisions Chris made for her new business. Cash basis accounting is a method of accounting in which transactions are not recorded in the financial statements until there is an exchange of cash. Cash basis accounting sometimes impacts the timing of revenue and expense reporting until cash receipts or outlays occur. For example, as you saw above, Chris measured the performance of her landscaping business for the month of August using cash flows. Cash accounting is far simpler to track than accrual basis accounting. Accrual basis accounting. Public companies reporting their financial positions use either U.S. Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS, as allowed under the Securities and Exchange Commission, SEC, regulations. GAAP is a set of accounting standards created by the Financial Accounting Standards Board, FASB, and the Governmental Accounting Standards Board, GASB. It's key to note that though they are similar in many areas, there are still key areas that differ between GAAP and IFRS. Therefore, when using financial statements, it's important to be aware of the standards under which they were prepared. However, public or private companies using GAAP or IFRS must prepare their financial statements using the rules of accrual accounting. Accrual basis accounting prescribes that revenues and expenses must be recorded in the accounting period in which they were earned or incurred, no matter when cash receipts or payments occur. It is because of accrual accounting that we have the revenue recognition principle and the expense recognition principle, also known as the matching principle. The accrual method is considered to better match revenues and expenses and standardizes reporting information for comparability purposes. Having comparable information is important to external users of information trying to make investment or lending decisions, and to internal users trying to make decisions about company performance, budgeting, and growth strategies. Who uses each method? Cash basis accounting can be more efficient and well-suited for certain types of businesses, such as farming or professional services provided by lawyers and doctors. However, the accrual basis of accounting is theoretically preferable to the cash basis of accounting because it takes into account the timing of the transactions, when goods and services are provided, and when the cash involved in the transactions is received. Cash can often be received a significant amount of time after the initial transaction. Considering this amount allows accountants to provide, in a timely manner, relevant and complete information to stakeholders. There are several reasons accrual basis accounting is preferred to cash basis accounting. Accrual basis accounting is required by GAAP because it typically provides a better sense of the financial well-being of a company. Accrual-based accounting information allows management to analyze a company's progress, and management can use that information to improve their business. Accrual accounting is also used to assist companies in securing financing, because banks will typically require a company to provide accrual basis financial income statements. The Internal Revenue Service requires businesses to report using accrual basis information when preparing tax returns. In addition, companies with inventory must use accrual-based accounting for income tax purposes, though there are exceptions to the general rule. So why might a company use cash basis accounting? Companies that do not sell stock publicly can use cash basis instead of accrual basis accounting for internal management purposes, or because they are exempt from such requirements in agreements such as a bank loan. Cash basis accounting is a simpler accounting system to use than an accrual basis accounting system when tracking real-time revenues and expenses. Think it through. Cash or accrual basis accounting. You are a new accountant at a beauty salon. The salon had previously used cash basis accounting to prepare its financial records, but is now considering switching to an accrual basis method. You have been tasked with determining if this transition is appropriate. When you go through the records, you notice that this transition will greatly impact how the salon reports revenues and expenses. The salon will now report some revenues and expenses before it receives or pays cash. How will this change positively impact its business reporting? How will it negatively impact its business reporting? If you were the accountant, would you recommend the salon transition from cash basis to accrual basis? Solution. Accrual accounting creates a more accurate picture of profit or loss, so the salon's owner can have a better understanding of its profitability from period to period. However, it can be more work to record under accrual accounting. If the salon is small and the profits and costs are easily understood, it might not be worth the extra effort to the owner to use accrual basis accounting. If the salon is seeking ways to better understand profits and costs, accrual basis accounting would be a great choice. Learning outcomes. By the end of this section, you will be able to assess the impact of business transactions on cash flow, define debentry accounting, and explain how it supports the accounting equation. How and when we record our transactions can have a significant impact on financial statements, especially the income statement, net income. In this section, you will explore the impact business transactions have on financial statements under each method. In doing so, you'll be introduced to debentry accounting and see how it functions to support the accounting equation. Timing of business activity versus cash flow. The first financial statement prepared is the income statement, a statement that shows the organization's financial performance for a given period of time. We already saw that Chris, who is a sole proprietor, started a summer landscaping business on August 1, 2020. She categorized her business as a service entity and used the cash basis method of accounting to record the initial operations for her business. Although Chris was using her family's tractor to get her work done, she was responsible for paying for fuel and any maintenance costs. So, on August 31, Chris realized she had only $250 in her checking account. This balance was lower than expected because she had spent only slightly less, $1,150 for brakes, fuel, and insurance, than she earned, $1,400, leaving a net income of $250. While she would like the checking balance to grow each month, she realized that most of the August expenses were infrequent brakes and insurance, and the insurance, in particular, was an unusually large expense. She knew that the checking account balance would likely grow more in September because she would earn money from some new customers. She also anticipated having fewer expenses. This simple landscaping example can be used to discuss the elements of the income statement, which are revenues, expenses, gains, and losses for a particular period of time. See Figure 4.2. Together, these determine whether the organization has net income, where revenues and gains are greater than expenses and losses, or net loss, where expenses and losses are greater than revenues and gains. Revenues, expenses, gains, and losses are further defined in the income statement provided. Chris, landscaping, income statement for the month ended August 31, 2020. Revenue $1,400, total revenue $1,400. Expenses: tractor brake repair 100, tractor fuel 50, Binus insurance 1,000. Total expenses $1,150, net income $250. Figure 4.2 income statement for Chris's landscaping. The income statement can also be visualized by the formula. Revenue minus expenses equals net income or net loss. 4.1. Let's change this example slightly and assume the $1,000 payment to the insurance company will be paid in September rather than in August. In this case, the ending balance in Chris's checking account would be $1,250. A result of earning $1,400 and only spending $100 for the brakes on the tractor and $50 for fuel. This stream of cash flows is an example of cash basis accounting because it reflects when payments are received and made, not necessarily the time period that they affect. At the end of this section, you will address accrual accounting, which does reflect the time period that payments affect. The accounting equation. It may be helpful to think of the accounting equation from a sources and claims perspective. Under this approach, the assets, items owned by the organization, were obtained by incurring liabilities or were provided by owners. Stated differently, every asset has a claim against it, by creditors and/or owners. Assets equals liabilities plus owner's equity. 4.2. You may recall from mathematics courses that an equation must always be in balance. Therefore, we must ensure that the two sides of the accounting equation are always equal. We will explore the components of the accounting equation in more detail shortly. First, we need to examine several underlying concepts that form the foundation for the accounting equation: the debentry accounting system, debits and credits, and the normal balance for each account that is part of a formal accounting system. Think it through. The accounting equation. On a sheet of paper, use 3 columns to create your own accounting equation. In the first column, list all the things you own assets. List only the asset itself. Don't worry about any associated liabilities expenses in that column. In the second column, list any amounts owed the liabilities. When you are done, total up all the assets, then total up all the liabilities. Now, use the accounting equation to calculate the net amount of the asset equity. To do so, subtract the total assets from the total liabilities. This figure makes the accounting equation balance and represents equity or an estimate of your net worth. Here is something else to consider. Is it possible to have negative equity? It sure is. Ask any college student who has taken out loans. At first glance, there is no asset directly associated with the amount of the loan. But is that, in fact, the case? You might ask yourself why you should make an investment in a college education. What is the benefit asset to going to college? The answer lies in the difference in lifetime earnings with a college degree versus without a college degree. This is influenced by many things, including the supply and demand of jobs and employees. It is also influenced by the earnings for the type of college degree pursued. Solution. Answers will vary but may include vehicles, clothing, electronics, include cell phones and computer gaming systems, and sports equipment. They may also include money owed on these assets, most likely vehicles and perhaps cell phones. In the case of a student loan, there may be a liability with no corresponding asset yet. Responses should be able to evaluate the benefit of investing in college and the wage differential between earnings with and without a college degree. Let's continue our exploration of the accounting equation, focusing on the equity component in particular. Recall that we defined equity as the net worth of an organization. It is helpful to also think of net worth as the accounting value of the organization. Recall, too, that revenues, inflows as a result of providing goods and services, increase the accounting value of the organization. So every dollar of revenue an organization generates increases the overall value of the organization. Likewise, expenses, outflows as a result of generating revenue decrease the value of the organization. So each dollar of expenses an organization incurs decreases the overall value of the organization. The same approach can be taken with the other elements of the financial statements. Gains increase the value equity of the organization. Losses decrease the value equity of the organization. Investments by owners increase the value equity of the organization. Distributions to owners decrease the value equity of the organization. Changes in assets and liabilities can either increase or decrease the value equity of the organization depending on the net result of the transaction. Let's look at Chris's landscaping business again and do the same quick exercise you did with your personal finances. If we were to total all of Chris's assets, we would find just $250 in cash. She's using the family's tractor, but she doesn't own the tractor, so it is not her asset. Her liabilities are currently $0, as she paid cash for all the expenses she incurred already. If we total her assets, we get $250. Liabilities total $0. Using the accounting equation, we find her equity to currently be $250, or assets $250, liabilities 0 equals equity $250. 3. Double entry accounting. Accounting is based on a double entry accounting system, which requires the following. Each time we record a transaction, we must record a change in at least 2 different accounts. Having 2 or more accounts change will allow us to keep the accounting equation in balance. Not only will at least 2 accounts change, but there must also be at least 1 debit and 1 credit side impacted. The sum of the debits must equal the sum of the credits for each transaction. In order for companies to record the myriad of transactions they have each year, there is a need for a simple but detailed system. Journals are useful tools to meet this need. Debits and credits. Each account can be represented visually by splitting the account into left and right sides as shown. The graphic representation of a general ledger account is known as a T account. It is called this because it looks like a T, as you can see with the T account shown in Figure 4.3. A general ledger account, or T account, shows debit, records financial information on the left side of each account, and credit records financial information on the right side of an account. A vertical line divides these sections. The account title goes above the debit and credit information. It is underlined. The underline and dividing line forms a T figure for 3T account. A debit records financial information on the left side of each account. A credit records financial information on the right side of an account. One side of each account will increase and the other side will decrease. The ending account balance is found by calculating the difference between debits and credits for each account. You will often see the terms debit and credit represented in shorthand, written as doctor or doctor and CR or CR, respectively. Depending on the account type, the sides that increase and decrease may vary. We can illustrate each account type and its corresponding debit and credit effects in the form of an expanded equation, see Figure 4.4. An expanded accounting equation. The general equation is assets equals liabilities plus common stocks minus dividends plus revenues minus expenses. Common stocks, dividends, revenues, and expenses are collectively known as equity. Figure 4. For expanded accounting equation. As we can see from this expanded accounting equation, assets accounts increase on the debit side and decrease on the credit side. This is also true of dividends and expenses accounts. Liabilities increase on the credit side and decrease on the debit side. This is also true of common stock and revenues accounts. This becomes easier to understand as you become familiar with the normal balance of an account. The balance sheet is a reflection of the accounting equation, see Figure 4.5. It has two sections, assets in one section and liabilities and equity in the other section. It's key to note that both assets and liabilities are broken down on the balance sheet into current and non-current classifications in order to provide more detail and transparency. Current assets are those that are consumed within a year. Assets that will be in use longer than a year are considered non-current. Current liabilities are those that will be due within a year. Non-current liabilities are those that are due more than a year into the future. Graphical representation of the accounting equation. The balance sheet shows assets and liabilities categorized as current and non-current. Various activities that affect the equity of the business are highlighted. Activities that have a negative impact include distribution to owners, expenses, and losses. Activities that have a positive impact include investments by owners, revenues, and gains. Comprehensive income can have a negative or positive effect on the owner's equity. Figure 4.5 graphical representation of the accounting equation. Both assets and liabilities are categorized as current and non-current. Also highlighted are the various activities that affect the equity or net worth of the business. Notice each account subcategory, current assets and non-current assets, for example, has an increase side and a decrease side. As you may recall, these are called T accounts, and they are used to analyze transactions. The basic components of even the simplest accounting system are accounts and a general ledger. An account is a record showing increases and decreases to assets, liabilities, and equity, the basic components found in the accounting equation. Each of these categories, in turn, includes many individual accounts, all of which a company maintains in its general ledger. A general ledger is a comprehensive listing of all of a company's accounts with their individual balances. Learning outcomes. By the end of this section, you will be able to explain the revenue recognition principle and how it relates to current and future sales transactions. Explain the expense recognition principle and how it relates to current and future purchase transactions. Assess the role of ethics in revenue and expense recognition. You've learned the basics of each method as well as the accounting equation and double entry accounting. Next, let's turn our attention to when we record transactions, as timing is key. Revenue recognition. Revenue is the value of goods and services the organization sold or provided to customers for a given period of time. In our current example, Chris's landscaping business, the revenue, or the value of services performed, for the month of August would be $1,400. It is the value Chris received in exchange for the services provided to her clients. Likewise, when a business provides goods or services to customers for cash at the time of the service or in the future, the business classifies the amount, S, as revenue. Just as the $1,400 revenues from a business made Chris's checking account balance increase, revenues increase the value of a business. In accounting, Revenue recognition involves recording sales or fees earned within the period earned. Just as earning wages from a business or summer job reflects the number of hours worked for a given rate of pay or payments from clients for services rendered. Revenues, and the other terms, are used to indicate the dollar value of goods and services provided to customers for a given period of time. Think it through. Coffee shop products. Think about a coffee shop in your area. Identify items the coffee shop sells that would be classified as revenues. Remember, revenues for the coffee shop are related to its primary purpose, selling coffee and related items. Or, better yet, make a trip to the local coffee shop and get a first-hand experience. Solution: many coffee shops earn revenue through multiple revenue streams, including coffee and other specialty drinks, food items, gift cards, and merchandise. Short-term revenue recognition examples. Two brief examples may help illustrate the difference between cash accounting and accrual accounting. Assume that a business sells $200 worth of merchandise. In some businesses, there are two ways the customers pay: cash and credit, also referred to as on account. Cash sales include checks and credit cards and are paid at the time of the sale. Credit sales, not to be confused with credit card sales, allow the customer to take the merchandise but pay within a specified period of time, usually up to 45 days. A cash sale would be recorded in the financial statements under both the cash basis and accrual basis of accounting. It makes sense because the customer received the merchandise and paid the business at the same time. It is considered two events that occur simultaneously: exchange of merchandise for cash. A credit sale, however, would be treated differently under each of these types of accounting. Under the cash basis of accounting, a credit sale would not be recorded in the financial statements until the cash is received, under terms stipulated by the seller. For example, assume that in the next year of Chris's landscaping business, on April 1, she provides $500 worth of services to one of her customers. The sale is made on account, with the payment due 45 days later. Under the cash basis of accounting, the revenue would not be recorded until May 16, when the cash was received. Under the accrual basis of accounting, this sale would be recorded in the financial statements at the time the services were provided, April 1. The reason the sale would be recorded is that, under accrual accounting, the business reports that it provided $500 worth of services to its customer. The fact that the customers will pay later is viewed as a separate transaction under accrual accounting. See Figure 4.6. A simple depiction of credit versus cash. On the left side, the statement of cash flows for the month ended May 31 shows cash flow from operations net earnings of $500 as cash. On the right side, the statement of cash flows for the month ended April 30 shows cash flow from operations net earnings of $500 as an accrual. Figure 4.6. Credit versus cash on the left is a credit sale recorded under the cash basis of accounting. On the right, the same credit sale is recorded under the accrual basis of accounting. Let's now explore the difference between the cash basis and accrual basis of accounting using an expense. Assume a business purchases $160 worth of printing supplies from a supplier vendor. Similar to a sale, a purchase of merchandise can be paid for at the time of sale using cash, also a check or credit card, or at a later date on account. A purchase paid with cash at the time of the sale would be recorded in the financial statements under both cash basis and accrual basis of accounting. It makes sense because the business received the printing supplies from the supplier and paid the supplier at the same time. It is considered two events that occur simultaneously: exchange of merchandise for cash. If the purchase was made on account, also called a credit purchase, however, the transaction would be recorded differently under each of these types of accounting. Under the cash basis of accounting, the $160 purchase on account would not be recorded in the financial statements until the cash is paid, as stipulated by the seller's terms. For example, if the printing supplies were received on July 17 and the payment terms were 15 days, no transaction would be recorded until August 1, when the goods were paid for. Under the accrual basis of accounting, this purchase would be recorded in the financial statements at the time the business received the printing supplies from the supplier, July 17. The reason the purchase would be recorded is that the business reports that it bought $160 worth of printing supplies from its vendors. The fact that the business will pay later is viewed as a separate issue under accrual accounting. Table 4.1 summarizes these examples under the different bases of accounting. Transaction under cash basis, accounting under accrual basis accounting. $200 sale for cash recorded in financial statements at time of sale, recorded in financial statements at time of sale. $200 sale on account not recorded in financial statements until cash is received recorded in financial statements at time of sale. $160 purchase for cash recorded in financial statements at time of purchase, recorded in financial statements at time of purchase. $160 purchase on account not recorded in financial statements until cash is paid recorded in financial statements at time of purchase. Table 4.1 How transactions are viewed under cash and accrual accounting. Businesses often sell items for cash as well as on account, where payment terms are extended for a period of time, for example, 30 to 45 days. Likewise, businesses often purchase items from suppliers, also called vendors, for cash or, more likely, on account. Under the cash basis of accounting, these transactions would not be recorded until the cash is exchanged. In contrast, under accrual accounting, the transactions are recorded when the transaction occurs, regardless of when the cash is received or paid. Concepts in practice. Ethics in revenue recognition. Because each industry typically has a different method for recognizing income, revenue recognition is one of the most difficult tasks for accountants, as it involves a number of ethical dilemmas related to income reporting. To provide an industry-wide approach, Accounting Standards Update Number 2014-09 and other related updates were implemented to clarify revenue recognition rules. The American Institute of Certified Public Accountants, AICPA, announced that these updates would replace U.S. GAAP's current industry-specific revenue recognition practices with a principle-based approach, potentially affecting both day-to-day business accounting and the execution of business contracts with customers. 1. The AICPA and the International Federation of Accountants, IFAC, require professional accountants to act with due care and to remain abreast of new accounting rules and methods of accounting for different transactions, including revenue recognition. The IFAC emphasizes the role of professional accountants working within a business in ensuring the quality of financial reporting. Management is responsible for the financial information produced by the company. As such, professional accountants in businesses therefore have the task of defending the quality of financial reporting right at the source where the numbers and figures are produced. 2. In accordance with proper revenue recognition, accountants do not recognize revenue before it is earned. Concepts in practice. Gift card revenue recognition. Gift cards have become an essential part of revenue generation and growth for many businesses. Although they are practical for consumers and are a low cost for businesses, navigating revenue recognition guidelines can be difficult. Gift cards with expiration dates require that revenue recognition be delayed until customer use or expiration. However, most gift cards now have no expiration date. So when do you recognize revenue? Companies may need to provide an estimation of projected or deferred gift card revenue and usage during a period based on past experience or industry standards. There are a few rules governing reporting. If a company determines that a portion of all the issued gift cards will never be used, it may write this off to income. In some states, if a gift card remains unused, in part or in full, the unused portion of the card is transferred to the state government. It is considered unclaimed property for the customer, meaning that the company cannot keep these funds as revenue because, in this case, they have reverted to the state government. Expense recognition. An expense is a cost associated with providing goods or services to customers. In our opening example, the expenses that Chris incurred totaled $1,150, consisting of $100 for brakes, $50 for fuel, and $1,000 for insurance. You might think of expenses as the opposite of revenue, in that expenses reduce Chris's checking account balance. Likewise, expenses decrease the value of the business and represent the dollar value of costs incurred to provide goods and services to customers for a given period of time. Think it through. Coffee shop expenses. While thinking about or visiting a coffee shop in your area, look around or visualize and identify items or activities that are the expenses of the coffee shop. Remember, expenses for the coffee shop are related to resources consumed while generating revenue from selling coffee and related items. Do not forget about any expenses that might not be so obvious. As a general rule, every activity in a business has an associated cost. Solution: costs of the coffee shop that might be readily observed would include rent, wages for the employees, and the cost of the coffee, pastries, and other items merchandise that may be sold. In addition, costs such as utilities, equipment, and cleaning or other supplies might also be readily observable. More obscure costs of the coffee shop would include insurance, regulatory costs such as health department licensing, point-of-sale credit card costs, advertising, donations, and payroll costs such as workers' compensation, unemployment, and so on. There are also unseen costs, such as aging of the building, if owned by the coffee shop, and wear and tear or aging of the equipment. Learning outcomes. By the end of this section, you will be able to define the key characteristics of a fixed asset. Explain how the cost of a fixed asset is spread throughout its useful life via depreciation. Assess the impact to net income of expensing versus capitalizing an item. Assets are items a business owns. For accounting purposes, assets are categorized as current versus long-term and tangible versus intangible. Any asset that is expected to be used by the business for more than 1 year is considered a long-term asset. These assets are not intended for resale and are anticipated to help generate revenue for the business in the future. Some common long-term assets are computers and other office machines, buildings, vehicles, software, computer code, and copyrights. Although these are all considered long-term assets, some are tangible and some are intangible. To better understand the nature of fixed assets, let's get to know Liam and their new business. Liam is excited to be graduating from their MBA program and looks forward to having more time to pursue their business venture. During one of their courses, Liam came up with the business idea of creating trendy workout attire. For their class project, they started silk screening vintage album cover designs onto tanks, tees, and yoga pants. They tested the market by selling their wares on campus and were surprised how quickly and how often they sold out. In fact, sales were high enough that they decided to go into business for themselves. One of their first decisions involved whether they should continue to pay someone else to silk screen their designs or do their own silk screening. To do their own silk screening, they would need to invest in a silk screen machine. Liam will need to analyze the purchase of a silk screen machine to determine the impact on their business in the short term as well as the long term, including the accounting implications related to the expense of this machine. Liam knows that over time, the value of the machine will decrease, but they also know that an asset is supposed to be recorded on the books at its historical cost. They also wonder what costs are considered part of this asset. Additionally, Liam has learned about the matching principle, expense recognition, but needs to learn how that relates to a machine that is purchased in 1 year and used for many years to help generate revenue. Liam has a lot of information to consider before making this decision. What is a fixed asset? An asset is considered a tangible asset when it is an economic resource that has physical substance. It can be seen and touched. Tangible assets can be either short-term, such as inventory and supplies, or long-term, such as land, buildings, and equipment. To be considered a long-term tangible asset, the item needs to be used in the normal operation of the business for more than 1 year, be of material value, and not be near the end of its useful life, and the company must have no plan to sell the item in the near future. The useful life is the time period over which an asset cost is allocated. Long-term tangible assets are known as fixed assets. It's also key to note that companies will capitalize a fixed asset if they have material value. A $10 stapler to be used in the office, for example, may last for years, but the value of the item is not significant enough to warrant capitalizing it. Businesses typically need many different types of these assets to meet their objectives. These assets differ from the company's products. For example, The computers that Apple, Inc. intends to sell are considered inventory, a short-term asset, whereas the computers Apple's employees use for day-to-day operations are long-term assets. In Liam's case, the new silkscreen machine would be considered a long-term tangible asset, as they plan to use it over many years to help generate revenue for their business. Long-term tangible assets are listed as non-current assets on a company's balance sheet. Typically, these assets are listed under the category of property, plant, and equipment, PP&E, but they may be referred to as fixed assets or plant assets. Apple, Inc. lists a total of $766 million in total property, plant, and equipment, net, on its September 2020 consolidated balance sheet. See Figure 47. As shown in the figure, this net total includes land and buildings, machinery, equipment and internal use software, and leasehold improvements, resulting in a gross PP&E of $103.526 million, less accumulated depreciation and amortization of $66.760 million to arrive at the net amount of $36.766 million. This report shows Apple's property, plant, and equipment net company's consolidated financial statement details as of September 30, 2020, and September 30, 2019. Figure 4. 7 Apple's property, plant, and equipment, net, September 2020. In Million 3, this report shows the company's consolidated financial statement details as of September 30, 2020, and September 30, 2019. Think it through. Classifying assets and related expenditures. You work at a business consulting firm. Your new colleague, Milan, is helping a client company organize its accounting records by types of assets and expenditures. Milan is a bit stumped on how to classify certain assets and related expenditures, such as capitalized costs versus expenses. They have given you the following list and asked for your help to sort through it. Help your colleague classify the expenditures as either capitalized or expensed, and note which assets are property, plant, and equipment. Expenditures: normal repair and maintenance on the manufacturing facility. Cost of taxes on new equipment used in business operations. Shipping costs on new equipment used in business operations. Cost of a minor repair on existing equipment used in business operations. Assets: land next to the production facility held for use next year as a place to build a warehouse. Land held for future resale when the value increases. Equipment used in the production process. Why are the costs of putting a long-term asset into service capitalized and written off as expenses, depreciated, over the economic life of the asset? Let's return to Liam's startup business as an example. Liam plans to buy a silk screen machine to help create clothing that they will sell. The machine is a long-term asset because it will be used in the business's daily operation for many years. If the machine costs Liam $5,000 and it is expected to be used in their business for several years, GAAP require the allocation of the machine's costs over its useful life, which is the period over which it will produce revenues. Overall, in determining a company's financial performance, we would not expect that Liam should have an expense of $5,000 this year and $0 in expenses for this machine for future years in which it is being used. GAAP address this through the expense recognition matching principle, which states that expenses should be recorded in the same period with the revenues that the expense helped create. In Liam's case, the $5,000 for this machine should be allocated over the years in which it helps to generate revenue for the business. Capitalizing the machine allows this to occur. As stated previously, to capitalize is to record a long-term asset on the balance sheet and expense its allocated costs on the income statement over the asset's economic life. Therefore, when Liam purchases the machine, they will record it as an asset on the financial statements. See journal entry in Figure 4. 8. A journal entry for machine done in cash as on Jan 1. The machine is recorded as a $5,000 debt. $5,000 is then allocated as a credit to cash in this journal entry. Figure 4.8 journal entry for machine cash. When capitalizing an asset, the total cost of acquiring the asset is included in the cost of the asset. This includes additional costs beyond the purchase price, such as shipping costs, taxes, assembly, and legal fees. For example, if a real estate broker is paid $8,000 as part of a transaction to purchase land for $100,000, the land would be recorded at a cost of $108,000. Over time, as the asset is used to generate revenue, Liam will need to recognize the cost of the asset. What is depreciation? When a business purchases a long-term asset used for more than 1 year, it classifies the asset based on whether the asset is used in the business's operations. If a long-term asset is used in the business's operations, it will belong in property, plant, and equipment or intangible assets. In this situation, the asset is typically capitalized. Capitalization is the process by which a long-term asset is recorded on the balance sheet, and its allocated costs are expensed on the income statement over the asset's economic life. Long-term assets that are not used in daily operations are typically classified as an investment. For example, if a business owns land on which it operates a store, warehouse, factory, or offices, the cost of that land would be included in property, plant, and equipment. However, if a business owns a vacant piece of land on which the business conducts no operations, and assuming no current or intermediate-term plans for development, the land would be considered an investment. Depreciation is the process of allocating the cost of a tangible asset over its useful life, or the period of time that the business believes it will use the asset to help generate revenue. Fundamentals of depreciation. As you have learned, when accounting for a long-term fixed asset, we cannot simply record an expense for the cost of the asset and record the entire outflow of cash in one accounting period. Like all other assets, when you purchase or acquire a long-term asset, it must be recorded at the historical initial cost, which includes all costs to acquire the asset and put it into use. The initial recording of an asset has 2 steps. Record the initial purchase on the date of purchase, which places the asset on the balance sheet as property, plant, and equipment at cost, and record the amount as notes payable, accounts payable, or an outflow of cash. At the end of the period, make an adjusting entry to recognize the depreciation expense. Depreciation expense is the amount of the asset's cost to be recognized or expensed in the current period. Companies may record depreciation expense incurred annually, quarterly, or monthly. Following GAAP and the expense recognition principle, the depreciation expense is recognized over the asset's estimated useful life. Recording the initial asset. Assets are recorded on the balance sheet at cost, meaning that all costs to purchase the asset and to prepare the asset for operation should be included. Costs outside of the purchase price may include shipping, taxes, installation, and modifications to the asset. The journal entry to record the purchase of a fixed asset, assuming that a note payable, not a short-term account payable, is used for financing, is shown in Figure 4. 9. A journal entry for fixed asset, such as a truck or building, as on Jan 1. The expense on the debit side should be equal to the amount of cash on the credit side in order to record the purchase of a fixed asset. Figure 4. 9. Journal entry for fixed asset. Applying this to Liam's silk screening business, we learn that they purchased their silk screen machine for $54,000 by paying $10,000 cash and the remainder in a note payable over 5 years. The journal entry to record the purchase is shown in Figure 410. A journal entry for equipment cash as on Jan 1. The equipment value is displayed on the debit side as $54,000, while the payment for the equipment is displayed on the credit side as cash of $10,000 and notes payable of $44,000. Figure 410 journal entry for equipment cash. Concepts in practice, estimating useful life and salvage value. Useful life and salvage value are estimates made at the time an asset is placed in service. It is common and expected that the estimates are inaccurate due to the uncertainty involved in estimating the future. Sometimes, however, a company may attempt to take advantage of estimating salvage value and useful life to improve earnings. A larger salvage value and longer useful life decrease annual depreciation expense and increase annual net income. An example of this behavior is waste management, which was disciplined by the SEC in March 2002 for fraudulently altering its estimates to reduce depreciation expense and overstate net income by $1.7 billion. 4. Components used in calculating depreciation. The expense recognition principle that requires that the cost of the asset be allocated over the asset's useful life is the process of depreciation. For example, if we buy a delivery truck to use for the next 5 years, we would allocate the cost and record depreciation expense across the entire 5-year period. The calculation of the depreciation expense for a period is not based on anticipated changes in the fair market value of the asset. Instead, the depreciation is based on the allocation of the cost of owning the asset over the period of its useful life. The following items are important in determining and recording depreciation. Book value, the asset's original cost less accumulated depreciation. Useful life, the length of time the asset will be productively used within operations. Salvage, residual value, the price the asset will sell for or be worth as a trade-in when its useful life expires. The determination of salvage value can be an inexact science since it requires anticipating what will occur in the future. Often, the salvage value is estimated based on past experiences with similar assets. Depreciable base cost, the depreciation expense over the asset's useful life. For example, if we paid $50,000 for an asset and anticipate a salvage value of $10,000, the depreciable base is $40,000. We expect $40,000 in depreciation over the time period in which the asset was used, and then it would be sold for $10,000. Depreciation records an expense for the value of an asset consumed and removes that portion of the asset from the balance sheet. The journal entry to record depreciation is shown in Figure 411. A journal entry for depreciation expense as on Jan 1. The figure shows that the depreciation expense on the debit side should be equal to the accumulated depreciation on the credit side. Figure 411 journal entry for depreciation expense. Depreciation expense is a common operating expense that appears on an income statement. It represents the amount of expense being recognized in the current period. Accumulated depreciation, on the other hand, represents the sum of all depreciation expense recognized to date, or the total of all prior depreciation expense for the asset. It is a contra account, meaning it is attached to another account and is used to offset the main account balance that records the total depreciation expense for a fixed asset over its life. In this case, the asset account stays recorded at the historical value but is offset on the balance sheet by accumulated depreciation. Accumulated depreciation is subtracted from the historical cost of the asset on the balance sheet to show the asset at book value. Book value is the amount of the asset that has not been allocated to expense through depreciation. It is important to note, however, that not all long-term assets are depreciated. For example, land is not depreciated because depreciation is the allocating of the expense of an asset over its useful life. How can one determine a useful life for land? It is assumed that land has an unlimited useful life. Therefore, it is not depreciated, and it remains on the books at historical cost. Once it is determined that depreciation should be accounted for, there are 3 methods that are most commonly used to calculate the allocation of depreciation expense: the straight-line method, the units of production method, and the double declining balance method. A 4th method, the sum of the year's digits method, is another accelerated option that has been losing popularity and can be learned in intermediate accounting courses. Note that these methods are for accounting and reporting purposes. The IRS allows firms to use the same or different methods to depreciate assets in calculating taxable income. Think it through. Fixed assets. You work for Georgia Pacific as an accountant in charge of the fixed assets subsidiary ledger at a production and warehouse facility in Pennsylvania. The facility is in the process of updating and replacing several asset categories, including warehouse storage units, fork trucks, and equipment on the production line. It is your job to keep the information in the fixed assets subsidiary ledger up to date and accurate. You need information on original historical cost, estimated useful life, salvage value, depreciation methods, and additional capital expenditures. You are excited about the new purchases and upgrades to the facility and how they will help the company serve its customers better. However, you have been in your current position for only a few years and have never overseen extensive updates, and you realize that you will have to gather a lot of information at once to keep the accounting records accurate. You feel overwhelmed and take a minute to catch your breath and think through what you need. After a few minutes, you realize that you have many people and many resources to work with to tackle this project. Whom will you work with, and how will you go about gathering what you need? Assume that on January 1, Liam bought a silk screen machine for $54,000. Liam pays shipping costs of $1,500 and setup costs of $2,500 and assumes a useful life of 5 years or 960,000 prints. Based on experience, Liam anticipates a salvage value of $10,000. Recall that determination of the costs to be depreciated requires including all costs that prepare the asset for use by the company. Liam's example would include shipping and setup costs. Any costs for maintaining or repairing the equipment would be treated as regular expenses, so the total cost would be $58,000, and after allowing for an anticipated salvage value of $10,000 in 5 years, the business could take $48,000 in depreciation over the machine's economic life. See Figure 4. 12. An example of the purchase price and depreciable base. The sum of purchase price $54,000, shipping cost of $1,500, and setup cost of $2,500 gives a total cost of $58,000. Salvage value of $10,000 is deducted to reach a depreciable value of $48,000. Figure 4.12 Purchase price and depreciable base. Straight-line depreciation is a method of depreciation that evenly splits the depreciable amount across the useful life of the asset. Therefore, we must determine the yearly depreciation expense by dividing the depreciable base of $48,000 by the economic life of 5 years, giving an annual depreciation expense of $9,600. The journal entries to record the first 2 years of expenses are shown, along with the balance sheet information. Here are the journal entry and information for Year 1, Figure 413. A journal entry for silk screen machine depreciation expense, Year 1, recorded on Deck 31. The depreciation expense amounting to $9,600 of the silk screen machine is debited against the credited accumulated depreciation of $9,600. To determine the net book value, the accumulated depreciation of the silk screen machine, $9,600, is subtracted from the total price paid for the silk screen machine, $58,000, to arrive at a net book value of $48,400. Figure 413 journal entry for silk screen machine depreciation expense, Year 1. After the journal entry in Year 1, the machine would have a book value of $48,400. This is the original cost of $58,000 less the accumulated depreciation of $9,600. The journal entry and information for Year 2 are shown in Figure 414. A journal entry for silk screen machine depreciation expense, Year 2, recorded on Deck 31. The depreciation expense amounting to $9,600 of the silk screen machine is debited against the credited accumulated depreciation of $9,600. Because 2 years of depreciation have occurred, the accumulated depreciation is now $19,200. To determine the net book value, the accumulated depreciation of the silk screen machine, $19,200, is subtracted from the total price paid for the silk screen machine, $58,000, to arrive at a net book value of $38,800. Figure 414 journal entry for silk screen machine depreciation expense, Year 2. Liam records an annual depreciation expense of $9,600. Each year, the accumulated depreciation balance increases by $9,600, and the machine's book value decreases by the same $9,600. At the end of 5 years, the asset will have a book value of $10,000, which is calculated by subtracting the accumulated depreciation of $48,000, 5 times $9,600, from the cost of $58,000. Units of production depreciation. Straight-line depreciation is efficient accounting for assets used consistently over their lifetime. But what about assets that are used with less regularity? The units of production depreciation method bases depreciation on the actual usage of the asset, which is more appropriate when an asset's life is a function of usage instead of time. For example, this method could account for depreciation of a silk screen machine for which the depreciable base is $48,000, as in the straight-line method. But now the number of prints is important. In our example, the machine will have total depreciation of $48,000 over its useful life of 960,000 prints. Therefore, we would divide $48,000 by 960,000 prints to get a cost per print of $0. 5. If Liam printed 180,000 items in the first year, the depreciation expense would be 180,000 prints times $0. 0.5 per print, or $9,000. The journal entry to record this expense would be the same as with straight-line depreciation. Only the dollar amount would have changed. The presentation of accumulated depreciation and the calculation of the book value would also be the same. Liam would continue to depreciate the asset until a total of $48,000 in depreciation was taken after running 960,000 total prints. Think it through, deciding on a depreciation method. Liam is struggling to determine which depreciation method they should use for their new silk screen machine. They expect sales to increase over the next 5 years. They also hope, that in 2 years they will need to buy a second silk screen machine to keep up with the demand for products of their growing company. Which depreciation method makes more sense for Liam? Higher expenses in the first few years or keeping expenses consistent over time? Or would it be better for them to think not in terms of time, but rather in the usage of the machine? Double declining balance depreciation. The double declining balance depreciation method is the most complex of the 3 methods because it accounts for both time and usage and takes more expense in the first few years of the asset's life. Double declining considers time by determining the percentage of depreciation expense that would exist under straight-line depreciation. To calculate this, divide 100% by the estimated life in years. For example, a 5-year asset would be 105, or 20% a year. A 4-year asset would be 104, or 25% a year. Next, because assets are typically more efficient and are used more heavily early in their lifespan, the double declining method takes usage into account by doubling the straight-line percentage. For a 4-year asset, multiply 25%, 100%/4-year life, times 2, or 50%. For a 5-year asset, multiply 20%, 100%/5-year life, times 2, or 40%. One unique feature of the double declining balance method is that in the first year, the estimated salvage value is not subtracted from the total asset cost before calculating the first year's depreciation expense. Instead, the total cost is multiplied by the calculated percentage. However, depreciation expense is not permitted to take the book value below the estimated salvage value, as demonstrated in Figure 4.15. Depreciation expense, accumulated depreciation, and book value, years 1-5. It shows the depreciation expense at 40% per annum, accumulating to $48,000 in 5 years. The accumulated depreciation is accumulated from $23,200 in year 1 to $48,000 in year 5. And the book value reduces from $58,000 in year 1 to $10,000 in year 5. Figure 4.15 depreciation expense, accumulated depreciation, and book value, years 1-5. Notice that in year 4, the remaining book value of $12,528 was not multiplied by 40%. This is because the expense would have been $5,011. 20, and since we cannot depreciate the asset below the estimated salvage value of $10,000, the expense cannot exceed $2,528, which is the amount left to depreciate. Difference between the book value of $12,528 and the salvage value of $10,000. Since the asset has been depreciated to its salvage value at the end of year 4, no depreciation can be taken in year 5. In our example, the first year's double declining balance depreciation expense would be $58,000 times 40%, or $23,200. For the remaining years, the double declining percentage is multiplied by the remaining book value of the asset. Liam would continue to depreciate the asset until the book value and the estimated salvage value are the same, in this case, $10,000. The net effect of the differences in straight-line depreciation versus double declining balance depreciation is that under the double declining balance method, the allowable depreciation expenses are greater in the earlier years than those allowed for straight-line depreciation. However, over the depreciable life of the asset, the total depreciation expense taken will be the same no matter which method the entity chooses. In the current example, both straight-line and double declining balance depreciation will provide a total depreciation expense of $48,000 over its 5-year depreciable life. Link to learning. McDonald's Corporation. See Form 10-K that was filed with the SEC to determine which depreciation method McDonald's Corporation used for its long-term assets in 2019. Hint: use the search feature to search for keywords in an annual report to find information more quickly. For example, search depreciation. You should find the information you are looking for on page 40 of the annual report. Based on the company's business model and the industry in which it operates, why do you think McDonald's chose this method of depreciating assets? Do you agree with this choice? Why or why not? Summary of depreciation. Table 4, 2 and Figure 4. 16 compare the three methods discussed. Note that although each time-based, straight-line and double declining balance, annual depreciation expense is different. After 5 years, the total amount depreciated, accumulated depreciation, is the same. This occurs because at the end of the asset's useful life, it was expected to be worth $10,000. Thus, both methods depreciated the asset's value by $48,000 over that time period. Depreciation method calculation. Straight line, cost minus salvage value, / useful life. 4. Units of production, cost minus salvage value, times units produced in current period / estimated total units to be produced. 5. Double declining balance, book value times straight minus line annual depreciation, percentage times 2. 6. Table 423 methods of calculating depreciation expense. A comparison of straight-line depreciation method, units of production method, and double declining balance method over 5 years. A fixed depreciation of $9,600 is charged for years 1-5 in the straight-line method. A fixed percentage is charged per unit in the unit of production method. In the double declining balance method, 40% of the current year's book value is charged until the stated salvage value is reached. Each method results in a total of $48,000 in depreciation charges. Figure 4. 16 straight-line depreciation, units of production, double declining balance method, years 1-5. When analyzing depreciation, accountants are required to make a supportable estimate of an asset's useful life and its salvage value. However, management teams typically fail to invest either time or attention into making or periodically revisiting and revising reasonably supportable estimates of asset lives or salvage values, or the selection of depreciation methods as prescribed by GAAP. 5. This failure is not an ethical approach to properly accounting for the use of assets. Accountants need to analyze depreciation of an asset over the entire useful life of the asset. As an asset supports the cash flow of the organization, expensing its cost needs to be allocated, not just recorded as an arbitrary calculation. An asset's depreciation may change over its life according to its use. If asset depreciation is arbitrarily determined, the recorded gains or losses on the disposition of depreciable property assets seen in financial statements 6 are not true best estimates. Due to operational changes, the depreciation expense needs to be periodically reevaluated and adjusted. Any mischaracterization of asset usage is not proper GAAP and is not proper accrual accounting. Therefore, financial statement preparers, as well as their accountants and auditors, should pay more attention to the quality of depreciation-related estimates and their possible mischaracterization and losses of credits and charges to operations as disposal gains. 7. An accountant should always follow GAAP guidelines and allocate the expense of an asset according to its usage. Concepts in practice. Ethical considerations. How WorldCom's improper capitalization of costs almost shut down the internet. In 2002, telecommunications giant WorldCom filed for the largest Chapter 11 bankruptcy to date, a situation resulting from manipulation of its accounting records. At the time, WorldCom operated nearly a third of the bandwidth of the 20 largest U.S. internet backbone routes, connecting over 3,400 global networks that serviced more than 70,000 businesses in 114 countries. 9. WorldCom used a number of accounting gimmicks to defraud investors, mainly including capitalizing costs that should have been expensed. Under normal circumstances, this might have been considered just another accounting fiasco leading to the end of a company. However, WorldCom controlled a large percentage of backbone routes, a major component of the hardware supporting the internet, as even the Securities and Exchange Commission recognized. If such an event were to happen today, it could shut down international commerce and would be considered a national emergency. 10. As demonstrated by WorldCom, the unethical behavior of a few accountants could have shut down the world's online businesses and international commerce. An accountant's job is fundamental and important. Keep businesses operating in a transparent fashion. Sources: WorldCom UNNET, Cybertelecom, ND/http://www, cybertelecom.org/industry/wcom, HTM, Dennis R. Beresford, Nicholas DeB. Katzenbach and C.B. Rogers, Jr. Report of the Special Investigative Committee of the Board of Directors of WorldCom, Inc., U.S. Securities and Exchange Commission. March 31, 2003. https://www. sec.gov/archive/edgar/7023,527/00009317630001862/dex991. HTM Learning Outcomes. By the end of this section, you will be able to outline the components necessary to calculate profit or loss, contrast revenue and gains versus expenses and losses, differentiate revenue and expense versus receipt or payment of cash. It's a common misconception that if a business has cash, they are making a profit, and if they are suffering a loss, they must not have any cash. While this could be true, it's not necessarily true. In this section, you'll explore key differences between cash flow, revenue, expense, profits, and losses, calculating profit and loss. Net income, net loss, is determined by comparing revenues and expenses. Net income is a result of revenues, inflows, being greater than expenses, outflows. A net loss occurs when expenses, outflows, are greater than revenues, inflows. In accounting, it is common to present net income in the following format. Recall that revenue is the value of goods and services a business provides to its customers and increases the value of the business. Expenses, on the other hand, are the costs of providing the goods and services and decrease the value of the business. When revenues exceed expenses, companies have net income. This means the business has been successful at earning revenues, containing expenses, or a combination of both. If, on the other hand, expenses exceed revenues, companies experience a net loss. This means the business was unsuccessful in earning adequate revenues, sufficiently containing expenses, or a combination of both. While businesses work hard to avoid net loss situations, it is not uncommon for a company to sustain a net loss from time to time. It is difficult, however, for businesses to remain viable while experiencing net losses over the long term. Shown as a formula, the net income loss function is: revenues are expenses E equals net income when letter 1D445 letter 1D438. Revenues are expenses E equals net loss when letter 1D438 letter 1D445. 7. To be complete, we must also consider the impact of gains and losses. While gains and losses are infrequent in a business, it is not uncommon that a business would present a gain and/or loss in its financial statements. Recall that gains are similar to revenue and losses are similar to expenses. Therefore, the traditional accounting format would be as shown in Figure 417. A simple depiction of gains and losses. Revenues, also called sales or fees earned, and gains are added. From that, expenses and losses are deducted to calculate net income or net loss. Figure 4:17 Gains and losses. Shown as a formula, the net income loss function, including gains and losses, is revenues letter 1D445 plus gains G minus expenses E minus losses L equals net income when R plus G, E plus L. 4:8 Revenues R plus gains G minus expenses E minus losses L equals net loss when E plus L, R plus G. 4:9 When assessing a company's net income, it is important to understand the source of the net income. Businesses strive to attain high-quality net income earnings. High-quality earnings are based on sustainable earnings, also called permanent earnings, while relying less on infrequent earnings, also called temporary earnings. Recall that revenues represent the ongoing value of goods and services the business provides, sells, to its customers, while gains are infrequent and involve items ancillary to the primary purpose of the business. For example, assume a bakery sells the truck it uses to deliver wedding cakes and experiences a gain on the sale. The bakery is not in the business of buying and selling trucks. It is in the baked goods business. Thus, the gain on the sale of the truck would be ancillary to the primary purpose of the business and represent a gain rather than revenue. We should use caution if a business attains a significant portion of its net income as a result of gains rather than revenues. Likewise, net losses derived as a result of losses should be put into the proper perspective due to the infrequent nature of losses. While net losses are undesirable for any reason, net losses that result from expenses related to ongoing operations, rather than losses that are infrequent, are more concerning for the business. Profit versus cash flow. Knowing the difference between the cash basis and accrual basis of accounting is necessary to understand the need for the statement of cash flows. Stakeholders need to know the financial performance, as measured by the income statement, that is, net income or net loss, and financial position, as measured by the balance sheet, that is, assets, liabilities, and owners, equity of the business. This information is provided in the income statement, statement of owner's equity, and balance sheet. However, since these financial statements are prepared using accrual accounting, stakeholders do not have a clear picture of the business's cash activities. The statement of cash flows solves this inadequacy by specifically focusing on the cash inflows and cash outflows. It also helps better delineate the difference between revenues and cash flow in versus expenses and cash flow out. As mentioned in prior sections, revenue can occur without cash actually flowing. For example, a customer may buy a good on account. Revenues would be recorded, but cash would not yet be received. The same is true on the expenses side. An expense can be incurred, such as an electric bill, but cash may not have been paid out yet. Thus, an expense is recorded and recognized on the income statement, but cash has not yet been given up. The statement of cash flows helps reconcile the difference between net income, a result of recorded revenues and expenses, and actual cash flow.